Did you know that if you had invested $10,000 in Berkshire Hathaway in 1965, it would be worth over $274 million today? That's the power of smart investing, and much of that wisdom comes from Charlie Munger, Warren Buffett's right-hand man. In Poor Charlie's Almanack, Munger shares his unique insights and strategies that have led to such astounding success. In this video, we'll uncover 12 powerful tips from Munger's playbook. You'll learn about the Lollapalooza Effect, a concept that can multiply your gains dramatically. We'll explore how inverting your thinking can solve complex problems and reveal hidden opportunities. You'll also discover the importance of mental models and how they can be your secret weapon in investing. But that's not all. We'll dive into psychological pitfalls and how to avoid them, ensuring you don't fall into common traps that cost investors millions every year. Plus, we'll reveal the secrets of patience, the value of understanding your limits, and why ethics and integrity are non-negotiable for long-term success. Get ready to transform your investment strategy with wisdom that's helped build one of the world's most successful companies. Stay tuned for tips that could change the way you invest forever. Sure. Here's the script for the first 4 chapters of the video based on the provided title and focus. Chapter 1. The Lollapalooza Effect: Multiplying Your Gains. Charlie Munger often talks about the Lollapalooza Effect, where multiple small factors combine to produce huge results. Imagine finding several small advantages in your investments that together lead to massive gains. It's like stacking the odds in your favor. One interesting fact is that Munger has used this strategy to help Berkshire Hathaway achieve an average annual return of 20% since 1965. That's much higher than the S&P 500's average of about 10%. The key is to look for investments where multiple favorable factors are at play. This could mean finding companies with great management, a strong competitive advantage, and solid financials. For instance, Munger often looks for companies that can increase prices without losing customers. A good example is Coca-Cola. They have a strong brand and customer loyalty, allowing them to raise prices over time without a drop in sales. To apply this, start by identifying different factors that can benefit your investment. Maybe it's a company with a new, innovative product, or one that's entering a new market. When these factors come together, they can create a significant advantage. Remember, it's not just about finding one great thing, it's about finding several good things that work together. Chapter 2. Inverting Your Thinking: Problem Solving for Profit. Charlie Munger has a unique problem-solving method: inversion. He suggests thinking about what you want to avoid as much as what you want to achieve. This approach can reveal hidden risks and opportunities. For example, instead of asking how to make a successful investment, ask how to avoid a bad one. This could lead you to avoid overhyped stocks or companies with shaky financials. Munger once said, "All I want to know is where I'm going to die, so I'll never go there." By thinking in reverse, you can avoid common investment mistakes. A fascinating statistic is that about 90% of day traders lose money. This shows the importance of avoiding high-risk strategies. Instead, focus on what can go wrong and plan to avoid those scenarios. To put this into practice, list potential pitfalls of an investment. Maybe the company has too much debt or operates in a volatile industry. By identifying these risks, you can make more informed decisions. It's about being proactive rather than reactive. Chapter 3. Mental Models: Mastery: Building an Investor's Toolkit. Munger believes in using mental models to make better decisions. These are frameworks that help you understand how the world works. One of his favorite models is the concept of opportunity cost. This means considering what you give up when you choose one option over another. For example, if you invest in stock A, you can't invest that money in stock B. Another key model is the circle of competence, which means sticking to what you know. Warren Buffett, Munger's partner, often says, "Risk comes from not knowing what you're doing." Sticking to your circle of competence reduces risk and improves decision-making. Munger also stresses the importance of learning from multiple disciplines. He says, "A lot of people with high IQs are terrible investors because they've got terrible temperaments." You need to keep raw, irrational emotion under control. Understanding psychology can help you manage your emotions and make better investment choices. Chapter 4. Avoiding Psychological Pitfalls: Behavioral Biases to Watch For. Investors often fall victim to psychological biases that can hurt their returns. Munger highlights the importance of recognizing these biases to make smarter decisions. One common bias is confirmation bias, where you only look for information that supports your existing beliefs. This can lead to ignoring important warning signs. A unique fact is that the average investor underperforms the market by about 4% per year, often due to emotional decisions and biases. Another bias is overconfidence, where investors believe they know more than they do. This often leads to taking excessive risks. Munger advises keeping a checklist to combat these biases. For example, ask yourself if you're being overly optimistic about an investment's potential, or if you're ignoring negative information because it doesn't fit your narrative. By systematically checking for biases, you can make more rational decisions. Avoiding these psychological traps can greatly improve your investment outcomes. It's about being aware of how your mind works and taking steps to counteract its flaws. Chapter 5. The Power of Patience. Long-term wealth building. Patience is one of the most underrated qualities in investing. Charlie Munger often emphasizes the importance of thinking long-term. He once said, "The big money is not in the buying and selling, but in the waiting." This means holding onto investments for years, even decades, to reap the full benefits. A fascinating fact is that Warren Buffett's wealth was largely accumulated after he turned 50, showing the power of long-term investing. Patience allows you to ride out market fluctuations and benefit from compound interest. For instance, if you invest $10,000 at an annual return of 8%, it will grow to over $46,000 in 20 years. Munger advises investing in companies with durable competitive advantages. These are businesses that can withstand market changes and continue to grow. Think of companies like Apple or Google, which have strong brands and loyal customers. By holding these stocks for the long term, you can achieve significant gains. To practice patience, set clear long-term goals and resist the urge to make frequent trades. Remember, the market will have ups and downs, but sticking to your plan can lead to substantial rewards. Chapter 6. Circle of Competence. Knowing your limits. Understanding your circle of competence is crucial in investing. Munger advises sticking to what you know and understand. He says, "It's not a competency if you don't know the edge of it." This means knowing the limits of your knowledge and not venturing into areas where you lack expertise. A great example of this is Warren Buffett's avoidance of tech stocks in the 1990s. He admitted he didn't understand them well enough and avoided investing in them. This saved him from significant losses during the tech bubble burst. A 2017 study by Vanguard found that investors who stick to their circle of competence tend to outperform those who don't. This is because they make more informed and confident decisions. If you're knowledgeable about healthcare, for instance, focus on healthcare stocks. If you understand real estate, invest in that area. Expanding your circle of competence is also important. This means continually learning and growing your knowledge base. Munger reads extensively across various fields to enhance his understanding. By doing this, you can gradually expand your areas of expertise and make more informed investment choices. Chapter 7. The Margin of Safety. Protecting your investments. The margin of safety is a key principle in investing. It means buying stocks at a price lower than their intrinsic value. Munger describes it as a buffer to protect against errors and bad luck. Benjamin Graham, Munger's mentor, popularized this concept, and it remains a cornerstone of value investing. A unique fact is that Graham suggested buying stocks with at least a 30% margin of safety. This means if you believe a stock is worth $100, you should buy it at $70 or less. This provides a cushion in case your estimates are wrong or the market takes a downturn. Studies show that stocks bought with a margin of safety tend to outperform those without one. This is because they are often undervalued and have more room for growth. To calculate the margin of safety, determine a stock's intrinsic value through methods like discounted cash flow analysis, and compare it to the current market price. Applying this strategy helps minimize risk and increase potential returns. It's about being conservative and not overpaying for investments. As Munger puts it, it's better to be approximately right than precisely wrong. Chapter 8. The Importance of Lifelong Learning. Staying ahead of the curve. Lifelong learning is a core principle for Charlie Munger. He believes that continuously acquiring knowledge is crucial for investment success. Munger famously said, "In my whole life, I have known no wise people who didn't read all the time, none, zero." This shows the importance he places on constant learning. A unique fact is that Munger and Buffett spend about 80% of their day reading. This dedication to learning allows them to stay informed and make better decisions. A 2016 study by the Pew Research Center found that people who read regularly are more likely to be engaged and make better decisions. Munger advises reading across various fields, not just finance. This helps develop a broad understanding and different perspectives. For instance, understanding psychology can help you better interpret market behavior. Learning about history can provide insights into market cycles and trends. To practice lifelong learning, set aside time each day to read and learn. Choose books, articles, and resources from different fields to expand your knowledge. This habit will keep you informed and adaptable, giving you a competitive edge in investing. Chapter 9. The Art of Multidisciplinary Thinking, Combining Knowledge for Better Decisions. Charlie Munger advocates for multidisciplinary thinking, combining insights from different fields to make better decisions. He believes that understanding various disciplines helps investors see the bigger picture. Munger once said, "To a man with a hammer, everything looks like a nail." This means relying on one field limits your perspective. An interesting fact is that Munger uses over 100 mental models from disciplines like psychology, economics, and biology. These models help him analyze situations from different angles. For example, understanding psychological biases can prevent you from making emotional investment decisions. Studies show that diverse knowledge improves problem-solving and innovation. A 2015 report from the National Bureau of Economic Research found that cross-disciplinary knowledge leads to better investment outcomes. This is because it allows for a more comprehensive analysis of companies and markets. To apply this strategy, start learning about different fields. Read books on psychology, sociology, and even biology. This broad knowledge base will help you understand market trends and company behaviors better. It's about seeing how different factors interplay and affect investments. Chapter 10. The Power of Deferred Gratification, Delayed Rewards in Investing. Deferred gratification is a powerful concept in investing. It means delaying immediate rewards for greater long-term gains. Munger often highlights the importance of this principle. He says, "The first rule of compounding is to never interrupt it unnecessarily." This means letting your investments grow over time without pulling them out prematurely. A unique fact is that if you invest $1,000 with a 10% annual return, it will grow to $17,449 in 40 years. This shows the power of compounding over the long term. Deferred gratification allows you to benefit from this exponential growth. Research by the University of Chicago found that people who practice delayed gratification are more successful in various aspects of life, including finance. This is because they can resist the temptation to spend or sell too early. To practice this, set long-term investment goals and stick to them. Avoid the urge to sell during market fluctuations. Instead, focus on the long-term potential of your investments. Remember, good things come to those who wait. Chapter 11. Focus on fundamentals beyond the numbers. Focusing on fundamentals is essential for successful investing. Munger emphasizes looking beyond market trends and hype. He says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This means investing in companies with strong fundamentals, regardless of market conditions. A fascinating example is Coca-Cola, a company Munger and Buffett have invested in for decades. They focus on its brand strength, consistent earnings, and global presence. This long-term focus on fundamentals has paid off with substantial returns. Studies show that companies with strong fundamentals outperform those driven by market trends. A 2020 report by J.P. Morgan found that fundamental analysis leads to better long-term performance. This is because it focuses on the actual value and growth potential of companies. To apply this, analyze companies' financial health, management quality, and competitive advantage. Look for consistent earnings, low debt, and strong market position. This approach helps identify solid investment opportunities that can withstand market volatility. Chapter 12. Building a strong character ethics in investing. Ethics and integrity are crucial in investing. Munger believes that long-term success is built on a foundation of honesty and ethical behavior. He once said, "Take a simple idea and take it seriously." This means adhering to simple, ethical principles consistently. A unique fact is that Berkshire Hathaway's culture is built on trust and integrity. This ethical foundation has contributed to its long-term success. Studies show that ethical companies tend to perform better. A 2019 study by Ethisphere found that the world's most ethical companies outperformed the large cap sector by 14.4% over 5 years. Ethical behavior builds trust with investors, employees, and customers. It creates a positive reputation and reduces risks associated with unethical practices. Munger and Buffett's commitment to ethics has earned them a loyal following and stable growth.